Did you know that your financial success might not be about how smart you are, but about how you behave with money? It's a surprising fact, but true. Our behaviors, emotions, and even our upbringing can significantly influence our financial decisions and outcomes. Imagine if understanding these psychological factors could help you build wealth and achieve financial freedom. Today, I'm excited to dive into an incredible book that explores the often overlooked psychological side of money. The Psychology of Money: Timeless Lessons on Wealth, Greed, and Happiness by Morgan Housel. This book isn't just about financial strategies or investment tips. It's about understanding the human behaviors and emotional factors that impact our financial decisions every single day. In this video, I'm going to take you through some of the most powerful lessons and insights from The Psychology of Money. Whether you're just starting on your financial journey or you're a seasoned investor, these timeless lessons can help you think differently about money and make smarter financial decisions. We'll cover why behavior often trumps knowledge when it comes to wealth building, the importance of understanding risk and uncertainty, and why knowing what enough is can be the key to financial happiness. We'll also explore the power of compounding and why starting early can be one of the best financial moves you can make, the psychological traps like overconfidence and loss aversion that can derail your financial plans, and the concept of tail events, rare occurrences that can have an outsized impact on your financial life. By the end of this video, you'll have a deeper understanding of how your mindset and behaviors influence your financial health and how you can apply these insights to your own life. So if you've ever found yourself wondering why you struggle to save, why you get nervous during market downturns, or why building wealth seems so complicated, stay tuned. The Psychology of Money has answers that could transform your approach to money and help you achieve the financial success you've always dreamed of. All right, let's dive into the first key lesson from Morgan Housel's The Psychology of Money: why behavior often matters more than knowledge when it comes to financial success. Lesson 1: Behavior over knowledge. Financial success is more about behavior than knowledge. Many people think that becoming wealthy is about having the right information or making the smartest investments. However, Morgan Housel argues that how you behave with money, your ability to manage your emotions, stay disciplined, and make consistent decisions, has a far greater impact on your financial success. Housel points out that even financial experts can struggle to achieve their financial goals if they make poor behavioral choices. It's not just about what you know, but how you apply that knowledge in real-life situations. For example, being patient and not panicking during market downturns can prevent you from selling off investments at a loss. Similarly, avoiding the temptation to chase after get-rich-quick schemes can help you build wealth steadily over time. Financial behavior is influenced by a variety of psychological factors, including individual experiences, upbringing, and even societal influences. By understanding and improving your financial behavior, you can make better decisions that lead to long-term financial success. One analogy from the book is comparing financial knowledge to a technical skill like playing chess. You can know all the strategies and openings in chess, but if you don't manage your patience and emotional control, you might still lose to a less knowledgeable but more composed player. Similarly, someone with basic financial knowledge but excellent behavioral control can outperform a highly knowledgeable person who makes impulsive decisions. Housel also shares the story of the lottery winner who, despite suddenly coming into a vast amount of money, ends up bankrupt due to poor financial behavior. This underscores the idea that without good financial habits, even large sums of money can quickly disappear. Lesson 2: Compounding and time. The power of compounding is one of the most important concepts in finance, and time is its best friend. Compounding allows your money to grow exponentially, but it requires patience and a long-term perspective. The idea is simple. The returns on your investments generate their returns, and over time, this effect snowballs. The longer you allow your money to grow, the more dramatic the results. Housel emphasizes that small amounts of money invested wisely over long periods can lead to substantial wealth. This concept is often overlooked because it requires a level of patience and forward thinking that many people struggle with. In the short term, the growth might seem insignificant, but over decades, the impact can be profound. This principle is particularly important for retirement savings, where starting early can make a huge difference in the amount you accumulate by the time you retire. Housel highlights Warren Buffett's success, noting that a significant portion of Buffett's wealth came after his 60s due to the power of compounding over many decades. Starting early and allowing investments to grow over time is more critical than trying to achieve quick gains. For instance, if you invest $1,000 at an annual return of 8%, it will grow to over $10,000 in 30 years due to compounding. This demonstrates why it's crucial to start investing as early as possible and to remain invested for the long haul. Lesson 3. Managing risk and uncertainty. Understanding and managing risk is crucial for long-term financial success. Financial markets are unpredictable, and there is always an element of luck involved. Housel explains that while you can't eliminate risk, you can manage it by diversifying your investments, maintaining an emergency fund, and avoiding high-risk speculative ventures. He also highlights the importance of psychological preparedness for market volatility. Recognizing that downturns are a natural part of the market cycle can help you stay calm and avoid making impulsive decisions based on fear. Additionally, acknowledging the role of luck in financial success can help you stay humble and make more rational decisions. It's essential to balance optimism about potential gains with a realistic understanding of potential risks. The book uses the story of the famous investor Jesse Livermore, who made and lost multiple fortunes. Despite his deep knowledge and skills, Livermore's inability to manage risk and his overconfidence led to his downfall. This illustrates the importance of preparing for the unexpected and not overestimating one's control over financial outcomes. Another example is the tech bubble of the late 1990s, where many investors, driven by the fear of missing out, poured money into tech stocks without considering the underlying risks. When the bubble burst, many lost significant amounts of money. This highlights the importance of understanding and managing risk in investing. Lesson 4. Frugality and saving. Saving money and living below your means is a fundamental aspect of building wealth. It provides a buffer against unexpected expenses and allows for greater financial freedom. Housel emphasizes that no matter how much you earn, if you spend all of it, you'll never build wealth. Frugality doesn't mean depriving yourself of all pleasures, but rather making conscious choices about spending. It involves prioritizing spending on things that truly matter to you and cutting back on unnecessary expenses. The act of saving itself instills discipline and helps you develop a mindset geared towards long-term financial stability. By living below your means, you can save more and invest more, which in turn accelerates the growth of your wealth through compounding. Housel shares the story of Ronald Read, a janitor and gas station attendant who amassed an $8 million fortune by being frugal and investing consistently over decades. His story highlights how ordinary people can achieve extraordinary financial results through disciplined saving and investing. Read lived a modest life, avoided debt, and invested in stable, dividend-paying stocks. His story serves as a powerful example of how frugality and consistent saving can lead to significant wealth over time, even without a high income. Lesson 5. Emotional and psychological factors. Emotions and psychological biases play a significant role in financial decisions. Recognizing and managing these biases is essential for making sound financial choices. Housel discusses several common biases such as overconfidence, where individuals believe they can predict market movements, and herd behavior, where people follow the crowd without independent analysis. He also talks about the impact of fear and greed on investment decisions. Fear can lead to panic selling during market downturns, while greed can drive individuals to take excessive risks. Understanding these psychological factors can help you develop strategies to counteract them, such as setting predefined investment rules or seeking advice from a financial advisor. The book discusses the concept of loss aversion, the tendency to prefer avoiding losses over acquiring equivalent gains. This can lead to poor investment decisions, such as selling stocks during market downturns out of fear, rather than holding on and benefiting from eventual recoveries. Housel also shares the story of the dot-com bubble, where many investors, driven by greed and the fear of missing out, invested heavily in tech stocks without considering the fundamentals. When the bubble burst, it resulted in significant financial losses for those investors. Lesson 6. Tail events. Tail events, or rare and extreme events, have a disproportionate impact on financial outcomes. While they are unpredictable, they must be accounted for in financial planning. Housel explains that these events, although rare, can have significant and sometimes devastating effects on your finances. Preparing for tail events involves having a diversified portfolio, maintaining liquidity, and having an emergency fund. It's also important to have realistic expectations about the frequency and impact of such events. By acknowledging the possibility of tail events, you can avoid being caught off guard and make more resilient financial plans. Housel references the 2008 financial crisis as a tail event that drastically affected the global economy. Despite its rarity, the crisis had a massive impact, underscoring the importance of preparing for unexpected, high-impact events in financial planning. Another example is the COVID-19 pandemic, which caused significant economic disruption worldwide. These events highlight the importance of having a financial safety net and being prepared for extreme scenarios. Lesson 7. Contentment and knowing enough. Knowing what is enough and being content with it is crucial for financial happiness. The relentless pursuit of more can lead to unnecessary risks and dissatisfaction. Housel emphasizes that contentment comes from understanding your financial needs and being satisfied with meeting them, rather than constantly striving for more wealth. This concept involves distinguishing between needs and wants and focusing on what genuinely brings you happiness and fulfillment. By recognizing what is enough, you can avoid the stress and anxiety associated with constantly chasing after greater wealth. This mindset also helps you make more prudent financial decisions, as you're less likely to take unnecessary risks in the pursuit of more. The story of Rajat Gupta, a former CEO who already had immense wealth but sought more through insider trading, illustrates the pitfalls of not recognizing when you have enough. His greed led to legal troubles and the loss of his reputation and freedom. Another example is the story of Richard Fosconi, a former Merrill Lynch executive who declared bankruptcy despite having once been very wealthy. His downfall was due to excessive spending and over-leveraging in the pursuit of an even more extravagant lifestyle. Lesson 8. The long game. Building wealth is a long-term endeavor. Patience, consistency, and avoiding short-term distractions are key to financial success. Housel emphasizes that short-term market fluctuations are often noise and should not distract from long-term goals. Developing a long-term perspective involves setting clear financial goals, creating a plan to achieve them, and sticking to that plan despite market volatility. This approach reduces the emotional stress associated with short-term market movements and allows you to benefit from the long-term growth of your investments. By focusing on the long game, you can avoid the pitfalls of trying to time the market or making impulsive decisions based on short-term events. The book contrasts short-term trading with long-term investing. It highlights how long-term investors like the late Charlie Munger have built substantial wealth by staying the course, despite market fluctuations, and focusing on the big picture rather than daily market movements. Housel also mentions the success of index fund investing, where investors benefit from the overall growth of the market over decades, rather than trying to pick individual stocks for short-term gains. These lessons remind us that financial success isn't just about numbers and strategies, it's deeply personal and psychological. For me, the most impactful takeaway is the importance of knowing what enough is. In a world constantly pushing us to want more, finding contentment with what we have can bring a sense of peace and security that's worth more than any financial gain. Applying these lessons means focusing on long-term goals, being prepared for life's uncertainties, and making decisions that align with our personal values and happiness. If you found these insights valuable, I highly recommend reading The Psychology of Money by Morgan Housel for a deeper understanding. The book is packed with stories and examples that bring these concepts to life. I'll leave a link to the book in the description below. Don't forget to like this video, share your thoughts in the comments, and subscribe to our channel for more content on personal finance and self-improvement. Thanks for watching and see you in the next video.